Now we've talked about Evergrande a lot, and it's funny because we've been talking about Evergrande. I think the first time we talked about it was November of 2020, and then we talked about it again different periods from that point, and then we had a big show on February 11th discussing the Chinese debt bubble, and again, and as I said in insights to clients last Friday. You could have said that since 2011. And the problem was always running room and capacity. And my view when I put this out and really made that call to short China back in February was, well, let's look at what's happening. And let's look at what's their leverage ratio. 2011 leverage ratio is very different than 2021. Financing growth, loans that were issued since 2018, getting financed with tax revenue. You're looking at a net drag on the economy and growth, because for every dollar invested, you're just not getting this movement. And that's something that we've been talking about, where it is different this time. They had 100 ghost cities in 2011, but they have 100,000 now. And again, just using numbers. I'm just trying to show that there is a leverage factor. It is different. What is the ghost city that breaks it? Is it the 101st, or is it the 1,000th and first, or the 10,000th and first? And it's hard to gauge. But the further down that road you go, the closer and closer you get to, I can't go any further. Like now I really have to take care of what's behind me and the mess that I've made to get to this point before I can get back to growth going forward, which was something that we've been trying to talk about. So when you look at, and I thought this was a great chart, because I think this highlights what we've been getting at. China goes through cycles of credit impulses. And as we've said multiple times, anytime there is a concern on economic growth, and I'm talking like a real concern, not, we missed the number, but a real economic slowdown where GDP is going to go negative, or there's going to be a big overhang for where the growth projection is, because remember, it's 6.5%, at least 6.5%. That's when they panic and issue more debt and issue more credit. And that's where we are with Evergrande. And I think when you look at the corporate high yield and you look at this Hang Seng offshore China corporates high yield, how it's gone continuously up. And anytime there's a concern, you see easing, you see credit impulses going up. And you can see anytime there's that hiccup, you had the sell-off in 2013 with the European crisis, you had more debt coming in, you had obviously the issues in 15. And that's why when we talk about this and we talk about China, China stimulated in 08, they did it again in 11, they did it again in 16, they did it again in 19, and then obviously into 20. And this is, you're seeing it, and this is, I think, why they're doing it. And now that we have this Evergrande hiccup, are they going to pivot? Are they going to try to do something to shift? Because Evergrande has $300 billion in debt, 3% of China's GDP, but the whole sector is 29%. So, anywhere from, depending on how you're calculating, 23 to 29%. But when you look at this backdrop and you look at the U.S., because some have said, the Lehman event, and as I said last week, it's not a Lehman event. I mean, we didn't know it was a Lehman event until it was a Lehman event. But this is more along the lines of Countrywide. This is more along the lines of Bear, where, okay, so the first guy's going to get bailed out. And this is where it pays to be a first mover, because as someone who was sitting in these seats back in 06, Bear Stearns took people by surprise. Lehman, at least in the industry, did not take people by surprise. But that was the moment the market lost confidence. Bear Stearns, you had JP Morgan coming in, we're going to get through this together, it's okay. That was, all right, you're picking up a good deal. Bear Stearns had a lot of value behind it. They had a good book to value. So, okay, we've got this. Then you had Lehman, where it's like, okay, maybe we don't got this. and that's where you start to get this shift. And now Evergrande is something similar. China said last night, they're working out a package. They're going to not so much bail it out, but it's going to be a bailout. It's going to be a restructuring. So the market can say they got this. We're okay. It's the next one and the next one, and at some point, that's when you start to get that loss of confidence that then gets that acceleration, which is why we thought that the move on Monday was a bit aggressive for what it was. But again, you're falling from much higher levels. So, and this is when I think this is good to highlight of where that pressure on Evergrande was. And you can see that President Xi has been talking about these property developers because he's really wanted to bring down the cost of housing. Remember, dual circulation strategy, common prosperity, trying to bring down the cost of living for the local consumer. And that's when you see that acceleration where all property developers got hit, not just Evergrande. And then things accelerated as the balance sheet got worse because in theory, it's really a Ponzi scheme. It's they're taking from Peter to pay Paul. So at some point, if you're running out of Peters to pay Paul, well, it's a house of cards. And that's what we started to see. And now you get that acceleration to the downside. So a list of 8 priorities released following an economic planning meeting in late 2020 not only denounced the disorderly expansion of capital, understood to have been code for speculation in property, it also advocated technological innovation in the pursuit of carbon neutrality. Such a transition may take several years to achieve, but it is clear that Xi's recent talks on the need for China to follow common prosperity, that it's serious. The propensity of real estate to leapfrog in value in sought-after areas while remaining undervalued in low, or at least underinvested in low-rent districts has been blamed for widening inequality gap between rich and poor. The slogan of common prosperity is a narrative change that paves the way for a shift in the growth model, says Miller from the Chinese Beige Book. It clarifies that a drop in GDP growth is not a failure for the Chinese Communist Party. Again, deflect. They want to try to, because they're now coming to the fruition that they really can't spin growth everywhere, but they want to try to distance where, hey, this isn't the party's fault. You guys invested in money-making things in places that have value. You ignored the commoner. This is on you, not us. And again, there's some of this politics at play trying to create that separation. So then when you look at the liquidity squeeze on China's listed developers, now this is all developers, not just the Evergrande, but it starts with someone. So as the company falters, its undoing raises a fundamental question for the world's second largest economy. Has China's property-driven growth model, the global economy's most powerful locomotive, has it run out of road? And as I've been saying since February of this year, yes, it has run out of room, and that's where we come to. And Leland Miller of China Beige Book agrees, saying that the leadership in Beijing has been more worried about Chinese growth than anyone in the West. There is a recognition that the old build playbook does not work anymore, and that is actually getting dangerous. The leadership now appears to be thinking that it can't wait any longer to change the growth model, which is where trying to drive the consumer, trying to drive local consumption, because this is something, and think, what does a building take? It takes cement, it takes steel, copper, PVC, all of these things that are essentially, at what point do you stop? Like, there's 90 million units just unfinished. And this isn't just an Evergrande thing. I mean, you're talking about a significant amount of capital has been sunk into these things, which then leads to who gave the loans and then that's when you get to those LGFVs, when you look at what the provinces have done. Then you get to special purpose bonds, and then you get to perpetual bonds that banks have issued. And you can see how it's this continuous cycle that has gone through the system, which again creates this overhang. So then when you look at any fall in growth would be swiftly felt worldwide. China has long been the biggest engine of global prosperity, contributing 28% of GDP growth worldwide from 2013 to 2018, more than twice the share of the U.S., according to an IMF study. even if China avoids a sharp and sudden crisis, which Jonas Golderman at Capital Economics said, its medium-term prospects are much worse than generally acknowledged, which, again, I've been saying it a while, but it's starting to come through. It's starting to filter through. It's starting to come into the mainstream, which is when, again, you start to get that loss of confidence. You start to see, okay, well, what is my exposure? What is this company's exposure? And you start looking at and adjusting your portfolio to minimize some of this Chinese risk. And this is when you look at this chart here, measuring the debt load of China's local government financing vehicles, the LGFVs. This is the debt to GDP calc. So when you look at the ratio and the local debt balances continuing to go up, and it's just getting started. They remember Xi said, you have to take off balance sheet debt and put it on your sheets. So that's why this is going to get worse and things are going to continue to lever up. And that's when you get some additional panic and that restructuring, because if there's one, there's many. And that's where Evergrande is very likely just the peak or the tip of the iceberg, and there's going to be more that's going to be uncovered over the next few months, which is when you start looking at, well, how is that going to impact things? Well, if China's manufacturing PMI slows, what does that do to Germany? Germany is a huge trade partner with China. Well, German business expectations are going to start to come down. The US is going to start coming under pressure. It's the second largest economy and the largest producer of stuff for the world. There is going to be a reverberating factor that is going to hit throughout, because if you go back, and not to say they're the same because they're not, but when you look at like the 98 Asian currency crisis, it took time to get to the US. The world, even in 98, was by no means as connected as it is today. So our interconnectedness, the fact that we've exported our supply chain exponentially over the last 10 years, we've exported inflation, we've exported what we do for industry and the industrial world. And again, this is why it's going to become a much bigger problem as China slows. So I should say, as the world realizes that China is going to slow, not that they are slowing, they have been slowing. The world has ignored it, but now you're starting to wake up to it, which is also going to be a drag, because we're already seeing this rollover in developed world PMIs. Emerging markets has already come negative. As we said before, it's going to turn positive and kind of bump along with emerging markets. Manufacturing PMI diffusion index, again, coming further and further negative, acting as these headwinds, because not only do you have to worry about cost, you have to worry about food, you have to worry about wages, and there's a lot of overhang when you look at the emerging markets, because they're going to feel the pinch of food, of inflation in general, more than anyone else. So then when you look at where are we in the cycle? So when we look at the expanding and accelerating, contracting and decelerating, you're getting more coming into, again, the wrong end of this cycle. And that's what that pressure looks like. And I thought this was a good one done by Market, looking at China 2020 Q3, China 2021 Q2, and now you're contracting and decelerating. And I think that this pivot, and a lot of these are Asian nations, and you're starting to get some of this slowdown as we get more of this movement on the emerging market side, as inflation weighs, as production weighs, how much of this can be passed through to the consumer. If you have the Chinese consumer already struggling further, because you have companies that are going to be firing, but then you look at what borrowings are. And when you look at the fact that a lot of these companies issue these MVPs or these investment vehicles, and all of a sudden they're gone. And Evergrande has taken in all this money, and people have invested with them, and their money is gone. There is no asset. And that is, I think, a bigger social problem, which is, again, leading to confidence, leading to, well, if Evergrande's not going to pay it, I'm going to redeem it over here. And that's when you start getting that redemption cycle that creates that run on a bank, that creates this exponential move, because banks only have so much cash. And there's so much leverage in the Chinese system. There's so much torque that any issue gets magnified and extrapolated even further. And that's when you look at regional comparison of income inequality. So this is where you see, as the CCP claimed to pull everyone out of poverty, but you've pulled everyone out of poverty, but what next? What will, are you going to go back into poverty? Because there's still a wide disconnect between a lot of these income inequalities, which could also create some social uprising. And this is what Xi is looking at. Remember, he wants to serve another term, even though he's technically up. There's going to be a lot of pressure to address some of this. And then when you turn it to the regional comparison of income inequality, China is worse than anyone else. So when you look at this common prosperity push, some of these guys have to give back, and you're starting to see some of this pivot to adjust this inequality, pacify some of the people, the working class, because they don't want that uprising. They don't want to see some of this move through, and because it's a communist nation. So how can there be income inequality in a communist nation? And I mean, we know the answer is those who have studied USSR and others, where you get one class of people and then everybody else. And this is some of those cycles that they're trying to pacify and fix. But these entities are so levered, and even the upper echelon, the people who have the most wealth, well, how levered are they to property? How level are the politicians to property? If you get a huge reversal down, well, maybe that takes care of inequality in itself, because you're going to have these people lose, millions upon millions, potentially billions of dollars as things start to adjust. So then when you look at sales revenue and you look at just across the property subsectors, and this is again from China Beige Book, when you look at just the cycles through in Q2 and Q3, how things continue to slow. There's just not that much revenue as you get this huge sucking sound from the system. So Evergrande, for all of the drama, is merely the symptom of a much bigger problem. China's vast real estate sector, which contributes 29% of the country's gross domestic product, GDP, is so overbuilt that it threatens to relinquish its long-standing role as a primary driver of economic growth and instead become a drag. So you're going to go from your driving force to your anchor. That's a big problem to try to handle. And now here's just an example. So this is some of the investments that can be done. And this is, again, just one example of many. But the promised 7.5% returns from the investment in Evergrande retail asset, which cost 200,000 renminbi, have not materialized. Instead, Evergrande is refusing to pay out as it conserves cash to stave off potentially huge defaults. And then an example, my parents have put all they have in Evergrande, says Zhu. This is no longer just an economic issue, she adds. This is absolutely a huge social issue. There will be serious consequences if the issue doesn't get properly solved. If my mother's health situation deteriorates because of this, adds Xi, I'm going to fight Evergrande every day. So again, social unrest. This is what they are going to try to avoid and pacify, to avoid some of this contagion as it goes down the line, which is where you start looking at bad loans arising in China's real estate. And how many of these were AAA, not even a month and a half ago? That's when it's hard to gauge, because as someone who's been through Chinese bankruptcies, you think you have waterfall X and you're going to collect 87 cents of every dollar. And then all of a sudden, company A and government entity B and social fund C just leapfrog you, and you're like, where did they come from? And all of a sudden, you think you're getting 87 cents. It's actually 37 cents. And that's when you start to get some of these fears, which again, it's just about confidence. That's all the market is at this point, is what is your confidence it's going to go up incrementally the next day? And am I going to get paid? And that fear is rising. As you look at the PBOC injected some liquidity into the market just to try to, again, stave off some of this fear, which is something that we're going to want to watch to look at the liquidity side. Because remember, they're trying to pull some of this liquidity out, and are they going to reverse? And they're going to balance it. And I think they're going to try to adjust that. Again, triple R cut is going to come again. You're going to start to see some of these adjustments over that time period. Because who is on the hook? Well, some of the biggest emerging market investors hold Evergrande bonds. And again, BlackRock's not going to go bankrupt because they lost $400 million in something. Not to say that they would lose all that money outright. But what about other stuff? What about other exposures? Do they have, what is their net exposure, not just in Evergrande, but in others? How much of that have they taken down? And you start to see how this can continue to expand out from just one entity. Because Chinese property developers' US dollar denominated debt to mature is fairly large, and it's going to continue to do so, and it accelerates through 22. But remember, they don't have the money to pay it off. So that's going to be more of a mature, like a roll, and less of I'm just going to pay you what I owe you. They're going to have to roll this debt. Well, knowing what we know now, at what rate are you going to roll it into? Are you going to feel comfortable owning the same amount you did previously? And that's when you start to get into some of these issues that continue to compound on itself, given the amount of leverage in the system. So then when we look at the number of residential buildings completed, and remember, Beijing and Shanghai are some of the most expensive cities in the world. Well, there's still a housing supply shortage in these first tier cities, which is why again, as we keep coming back to, you have to look at what the CCP is saying and their policy, because typically there's some underlying economic thing that's driving it. And here is another perfect example of it, where housing supply shortages continue to drive, with Beijing and Shanghai, again, just showing where some of this, which is why China's and Xi and the CCP are trying to get, the rural development pushing, moving people out of the cities, providing additional opportunities to try to mitigate against some of this massive housing increasing in price. But where is the residential floor space started and under construction continues to fall? Chinese housing sales and starts are contracting. So you're seeing this contraction while you're trying to also drive completion of assets. And there's this, well, you need housing, but you need housing in certain areas, but you don't have housing in certain areas, but you're going after their debt because they're over levered. I mean, Evergrande, they bought a soccer team, they bought a EV company, they bought a food company, so they were taking this money, they just weren't spending it where they were supposed to, of completing these assets that they took the money in for, again, leading to some of these additional problems. And then Macau visitors, just looking at how the consumer continues to slow, fell again in general. And then when we look at China industrial production and in China nominal retail sales, this is where you're looking at a continuous slowdown. And the retail sales is where we have been shining a big, gigantic, bright light on it as the biggest issue, because that's what they want to drive up. That is what they were relying on to replace property investment in building and trying to replace some of their exports, and they're just not getting there because people don't have the money to do it. There is a slowdown in population growth. There are a lot of things that are continuing to go through. So then when we look at China's domestic slowdown worsening in August, this is where you continue to see, again, retail sales. All of these things are weighing down on and then when you look at if this continues, then exports will slow because the global economy is going to slow, because we're seeing developed economies also pare back. And then when we turn to India, so India is also coming and hitting a headwind on the economic side. So vaccine doses are moving along, but power demand is falling. Consumer sentiment is weak. You're seeing some of these pressure points that, again, and that's why we look at diesel consumption, diesel movements, because there is a lot of overhang that continues throughout this market, which is why when you look at consumer confidence survey 1 year ahead of expectations, getting a little bit better. But when you look at current expectations, still at the lows, coming off the bottom, but still not back to where we were pre-COVID in the slightest. And the same can be said for future expectations as this pressure continues to grow, which then rounds us out with India FDI inflow rises but fails to aid capital formation. So what does that mean? So foreign direct investment. So remember, it's the U.S. is investing less in China, has to go somewhere. So we are seeing more investment in India. But net inflow contributing to gross capital formation is falling. So the net inflow as a share of gross capital formation in general continues to go down. So it's not generating the same type of growth it has in the past. There's law of big numbers where, the India is a different country from 13 to 21. There's going to be some of these shifts. Now, it's going to be positive and it's going to continue to attract investment, and they're going to try to incentivize that. But there's also been an issue of concern on inflation, concern on economic growth, which has kept people from dumping more money in, keeping a certain amount of weight over it, which again is a much bigger issue in general. So when I look at this, and there's a lot of issues and landmines that remain, especially in the emerging market world on the growth side, which I think is going to continue to reverberate down through the rest of the economy. So I know we covered a lot. It was a little bit faster than normal, trying to speed things up so you're not sitting there listening to me rant on and my droning voice. If you have any questions, you can find me on LinkedIn, again, Twitter, email, or comments in here. So thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.